Welcome to Taking Stock for the week ending the 25th of March 2022. Where joining me today is our Senior Portfolio Manager, Matthew Swartz, to stream to you all things share market. Welcome, Matt, and great to have you on board again.
Thanks, Kien, and great to be joining you.
So over the last 2 weeks, there's been a rebound in the markets, and that's driven by investor optimism regarding a ceasefire between Russia and Ukraine. Also, the Federal Reserve, the US Federal Reserve, alluding to the strong US economy, and China mentioning that they will provide more stimulus to manage COVID-related lockdowns.
Yeah, and despite the inflation headwinds we're clearly experiencing across the globe, there are pockets of the Aussie economy where investors should remain quite optimistic. Australia is obviously a net exporter in commodities, including minerals, energy, gold, and agriculture. And this supply-constrained inflationary environment that we're currently experiencing, the elevated commodity prices will act as a shock absorber of sorts for the Aussie economy and will lead to high earnings revisions across our resources exposure, including Alkane Resources, IGO, Rio Tinto, Woodside Petroleum, Lynas Rare Earths, and South32. So it makes sense to have some exposure to these stocks because the cycle, we feel, remains quite favourable. And for the income investor, the significant free cash flow that we're experiencing and being generated should continue to sustain these attractive dividend yields. So I think BHP, Rio Tinto, and South32, they're all on gross dividend yields in excess of 9%. Very, very attractive.
That's right, and those dividends look quite sustainable as well. And despite the inflationary pressures and elevated geopolitical risks, earnings expectations for the market have continued to rise, as indicated by the chart on screen, which compares the corporate earnings estimates, that's in black, with the All Ords index in blue. The convergence between share prices and earnings over the last few weeks suggests that equities are relatively cheap compared to history.
Correct, Kien. And shifting our attention to the upcoming federal budget at the end of the month, and this could potentially provide a boost to the economy and to corporate earnings. Now, the budget deficit is running at about $13 billion lower than we were expecting, and this should allow some leeway for some stimulus measures. The net benefit we are experiencing through favourable terms of trade conditions at the moment, with commodity prices exploding higher as they are, is likely to provide the incumbent government with some capacity to provide relief to households through that are struggling with food and energy costs soaring at the moment. So it's an election year, so we can expect temporary tax cuts or family assistance packages to be a key pillar of any election campaign. Now, with all these inflation pressures mounting and many of the retailers cycling very strong numbers, most of you would have noticed that we've actively reduced our exposure to consumer stocks. However, the fiscal stimulus we're expecting through the upcoming election should provide some relief to the consumer stocks we continue to remain quite favourable on. This includes Baby Bunting, Premier Investments, Lovisa, JB Hi-Fi, Domino's Pizza, Collins Food, ARB Corp, Wesfarmers Coles, and Woolworths.
Yeah, and some of these are off a very high earnings base, but they continue to prod along quite nicely. But let's now turn our attention to some of the star stock highlights for the week. Respiratory care manufacturer and borderline star growth stock Fisher Paykel provided a financial year 22 operating revenue guidance, which was about 4% below consensus forecasts. And this is expected to lead to analysts revising their revenue and earnings forecasts lower over the next couple of weeks, with earnings growth this year expected to fall quite steeply by over 20%. Now, management attributed the weaker revenues to the rapid drop in COVID cases and also the hospitalizations with the Omicron wave. Furthermore, there was a relatively mild flu season in the Northern Hemisphere, which meant less need for respiratory support within the hospital environment. Meanwhile, higher freight costs also continued to impact their profit margins.
So many of you out there are probably wondering whether the share price weakness represents an opportunity. And while these higher freight costs and supply chain impacts are expecting these to linger for the next 18 months or so, we feel the company's longer-term growth profile remains well intact. According to some market participants, Fisher Paykel sold nearly 5 to 7 years worth of respirator devices over the last 2 years. So clearly some level of normalisation was expected to happen. However, the substantial installed base of devices offers leverage to sell a high number of consumables in the future. So simply put, this business is stronger than it was 2 years ago, and the share price doesn't reflect that reality. So we feel the price weakness represents opportunity, although a recovery may take some time to be realised. So patience is obviously necessary here.
Yeah, thanks, Matt. And we also initiated coverage of borderline Star Growth stock and Star Income stock, Nine Entertainment, this week. And you should be familiar with Nine Entertainment because it's an Australian media and entertainment company with investments spanning television, video on demand, print, digital, and radio as well. But many investors may be wondering why we're investing in this company if traditional broadcasting, such as free-to-air television, is facing structural challenges because consumers are moving towards online platforms such as Netflix. And the reason is Nine has countered this shift by growing its digital businesses as well and by creating its own Netflix alternative, which is called Stan.
Yeah, Ken, and this was articulated by the lift in ROE over first half 22 due to the contribution from their higher margin digital business, which reported revenue growth of near 31% on the PCP. Now, from an income perspective, the company has low levels of gearing, a solid balance sheet, and this is represented by its strong financial health score. Its dividend yield of 6.8% grossed up is supported by solid free cash flow generation and a conservative payout ratio of 72%. And that 72% allows management to reinvest some of the retained earnings back into the business.
And looking at our corporate calendar for the week ahead, no companies are expected to report, but we did have Premier Investments today who reported in line with market expectations. Positively, the second half has opened strongly with total global revenue for the first 5 weeks up 6%. Meanwhile, online sales now represent 25% of total sales, and that's also helping with their profit margins. For income investors, next week we have Arena REIT, Charter Hall Long WALE, and Charter Hall Social Infrastructure going ex-dividend. And for highly trend sensitive investors utilizing the SD Max, which is the Stock Doctor moving average crossover, we note that Coles Group and Spark New Zealand have triggered bullish signals, while GUD holdings turn bearish. Meanwhile, those who are moderately trend sensitive can refer to the SD30 TSR, which is the Stock Doctor 30% stop loss or gains from its highs or lows. On this indicator, Fisher Paykel Healthcare triggered an exit this week. In Under the Microscope this week, we cast our lens onto a small cap stock that specializes in the development and commercialization of computerized tests for neurodegenerative disorders. In other words, disorders of the brain. The borderline star stock is called Cogstate.
And the company operates three specific segments. You've got clinical trials, which is about 90% of group revenue, healthcare, 10% of group revenue, and the loss-making side, which is their academic research. Now, while the majority of clinical trials revenue is associated with Alzheimer's disease, the near-term growth driver is the expansion of the company's online brain research in partnership with a Japanese company called Eisai. I hope I'm pronouncing that correctly. Now, Eisai is a global pioneer in the study of dementia, and in late 2019, the two companies signed a global distribution agreement for the commercialization of Cogstate's digital brain assessment software. The agreement already covers the Japanese market, with the launch into the US, EU, and China markets over the next couple of years. The agreement has guaranteed minimum hurdles, which provide some level of visibility around future revenue, with expectations sitting at about 40% growth for this year.
And it's great to see Chairman Martin Meyer, who is a member of the prominent Meyer family. He's been involved with the company pre-IPO and holds about 13% of total shares on issue. The company's largest shareholder, though, is David Dolby. He holds that 15%, who is a private equity investor based in San Francisco. Hence, we believe there is an alignment of interest between shareholders and the directors.
And liquidity may be an issue for some investors, given the stock's daily average turnover is just below 250,000. So we therefore recommend members size their positions in accordance with their own liquidity limits, so they're not caught out in the event they need to exit their positions.
with strong commodity prices helping the performance of resource stocks. An interesting question that was asked by one of our members earlier this week is how much resources exposure should you have in your portfolio, and are we comfortable with the number of resource stocks within our star stock universe? To understand the amount of exposure you want in your portfolio, you will need to understand the active risks associated with holding resource stocks and invest according to your tolerance to that risk.
And although the quality of a mining or energy company is ultimately driven by the depth of the resource, the length of its mine life, and its cost of production, the ultimate driver, at least in the short term, for share price is tied to the underlying commodity price, which is cyclical, it's volatile, and as we know, it's often unpredictable. Hence, the outlook under Golden Rule 3 for resource companies can change quite quickly and should not solely be relied upon, even if there are many analysts covering the stock.
And also, because quantitative techniques are backward looking, it's difficult to find fundamental factors for resource stocks that can help your portfolio outperform the market consistently. Rather, for resource stocks, you need to apply more of a qualitative overlay under Golden Rule 3 to help you understand the demand and supply dynamics of the underlying commodity price. For example, right now, we are comfortable in holding around 24% of our star stock portfolio in resource stocks because we are in an environment where demand for resources is outstripping supply due to the elevated geopolitical risks supporting gold and oil, supply chain bottlenecks, and also stronger demand for commodities driven by the ongoing global economic recovery from COVID.
And in addition to that, vulnerable property developers in China, such as Evergrande, as we've spoken about in previous segments, are racing to complete construction projects so that they can sell apartments and use the proceeds to sell down their enormous debt levels. So this urgency by Chinese real estate companies to complete unfinished projects is providing huge support for our exports, such as iron ore. But over time, investors will need to keep an eye on the resource companies closely because once the cycle turns, it often happens quite quickly. So don't overexpose your portfolio to iron ore because these Chinese property developers are under real regulatory pressure. And there's the other element there, the Brazilian global miner Vale are trying to get production back to full utilisation. So there's going to be an increasing global supply dynamic to balance that out as well.
Yeah, so how do you manage this? And this is where Stock Doctor comes in handy. For trend-sensitive investors, you can set up price alerts such as the SD30 TSR under the Alert Manager to remind you to remove a resource stock when the trend has changed. You can also use the change alerts, such as the consensus price targets change or the EPS estimates change to help you sell a stock once the price targets or earnings drop by more than, say, 10%. These factors are known as momentum factors and work better for resource stocks, which are driven by movements in the commodity price. You can also find these figures under Golden Rule 3, Outlook and Active Risks, also under Golden Rule 5, the share price value, or you can click on Price Target under Golden Rule 4, the share price sentiment, to see the trends in the target prices over time. And if you're unsure, you can pick up the phone and speak to our analysts.
And although our portfolio of star growth and borderline stocks appear to be well concentrated in resources stocks, when you compare it to the All Ordinaries Index with a combined weight in materials and energy of near 24%, our position in these sectors is not significantly different to that of the index. And in any sense, we are benchmark agnostic. So that means that our sector allocation is driven by the strength of the company's fundamentals rather than us trying to minimize tracking error, i.e. hugging the benchmark, which many of the other fund managers in the marketplace do.
Well, Matt, that's all we have time for today, but thanks again for your contributions.
My pleasure. Thanks for having me, Kien.
So just to remind our investors that you can register to our new weekly Monday Lincoln Live question and answer forum, where Tim Lincoln will share with you his insights into the market and investment strategies to help you navigate the current market volatility. But to summarize, despite ongoing uncertainty with regards to the Russia-Ukraine crisis and inflationary pressures, the stocks remain supported by a strong earnings trend and an upcoming federal budget. The outlook for resource stocks can be highly uncertain though, so make use of some of Stock Doctor's tools such as the Alert Manager, the earnings revisions, consensus target price changes, and technical alerts like the SD30 TSR to help you manage your exposures. In the meantime, take care and have a happy, healthy, and prosperous week, everyone.